Ladies and gentlemen, good day. You're highly welcome to this presentation of the Dicalo Consulting Group. Dicalo Consulting Group is a management consulting firm, and we help companies in the providing solutions to their business challenges. And we've realized that some of the main challenges which businesses are facing are being able to cost their products, especially companies that are in the construction industry, as well as those which are in non-construction industries. At times, most companies actually making a tremendous amount of losses, and they really cannot explain where the issue is coming from. We have had situations where some clients have been making a lot of losses, and upon investigations, we came to realize that they had a lot of problems with their costing. Because, to be frank, there are so many companies who actually do not understand their total cost of operation. They really don't know their direct costs, their indirect costs, as well as other expenses that are related to their sales. And as a result, if a company is not able to identify its cost of production or its cost of operation, then for sure it will be very difficult for the company to be able to make a profit. Yes, to be able to be profitable, it's going to be very difficult for a company which is unable to ascertain the actual cost of production. So basically, in this session which is being organized by the Dicalo Consulting Group, we'll be presenting to you a case study of how you can actually compute your costs in a construction company, or in a facility management company, or in a service providing company. So basically here we have a presentation on how to prepare our cost sheet. Like I've said, this video is brought to you by the Dicalo Consulting Group. We request you to sign on, to subscribe to our YouTube channel, so that you'll be able to follow up on any new videos which have been posted by us. Today I'm making this presentation on the 13th of March 2023. So let me change the date. So this is a sample example of a cost sheet, or of a quotation. Now basically, like I've said, for you to be able to be profitable, for every organization to be profitable, they need to be able to know their total cost of operation, total cost. And the total cost of a company shall consist of the direct cost, plus the indirect cost. Now when you take the sum of the direct cost so the total cost of a company should consist of what? Direct cost plus indirect cost, to give you what? Your total cost. Now there are so many components that make up the direct cost of a company, as well as other costs that make up the indirect cost of a company. Like I've explained in this session, no company will ever be profitable if the company is not able to ascertain their total cost of production. Because if you don't know the total cost which you are incurring in providing a particular service, or in manufacturing a particular product, how then do you actually go about costing or pricing this product to consumers, or to third parties who may be acting as agents on your behalf? In this session, like I've explained to you the case study of a construction company, and we're going to see how the costing is being done at the level of this company. Okay, now this is what we call our cost sheet. This is our cost sheet, and this is our quotation. This is our quotation. So basically here you have the number. This is one of our clients which actually offered service, rendered a lot of services to them. They are into project management. So you have the letterhead, you have the address, and then the date of the quotation, you have the quotation number, and then you have the customer ID, and then you have the validity of the quotation. For sure, some companies, their quotation, for sure, if you're giving the companies a quotation today, it's for sure that within a week or two, many things will have changed. Maybe the raw material cost will have changed, maybe the labor cost will have changed, or maybe there will be inflation or be deflation. We really understand that given the level of economic activities that are changing globally in the world, it's been normal that you need to specify the validity or the period during which the customer can either decide to approve the quotation or not. So now, for us to be able to calculate or compute our quotation, or to know the amount that we're going to quote to our client, we need to establish what we call a cost sheet. In big companies, this cost sheet is already prepared by the finance team, by the accounting team, and then it is handed over to the estimation team. Once the cost sheet or the costing parameters have been prepared by the accounting team, using these costing parameters, the estimation department should be able to prepare a cost sheet and thereby know the amount, the price that will be quoted in their quotation before they send the quotation to the customer of approval. So in this situation, we are assuming that from raw material that we have accepted the contract, and they want us to charge a profit margin of, let's just say, 30%. Yeah, that's the profit margin or profit markup. This is our markup here, as per company policy, is what? 30%. 30% on cost. So now let's see. Okay, if we want to undertake this project, we want to look at what are the materials. Let's assume that it's a building that they want us to construct. Let's say a two bedroom apartment, and they want us to do this construction. Okay, what are the things that we need to take into consideration before we quote this, before we prepare our quote, or we quote a price for this particular project? The very first thing is that we need to look at the raw materials. Let's assume that we're going to be using raw material A. Let's say we're going to be using raw material A. And for this raw material A, we need quantity of, say, 200. And one unit is costing us, let's say, 300. For the purpose of this case study, we're going to assume that all our values are in AED, or say in USD. Yeah, everything is in USD. So now we go at the level of, say, direct material B. Direct material B. And then let's assume we're going to be using 300 units, and one unit is going to cost us, let's say, $500. We have the cost. And then now let's assume that we have another raw material, let's say, we call it raw material X, and then we're going to be using, say, 900, unit price of 60. We have this. Then let's assume that we have another direct material here. Now we have labor cost. Let's assume we're not using, say, 300 employees, or let's say 50 of the various categories, and let's assume that averagely is gonna cost us, let's say, $1,900. Okay, just be patient, just follow up on what we're doing here. For sure, at the end of the day, you're gonna learn a lot. You'll be able to know how to price a job, you'll be able to know how to code a job, you'll be able to know how to prepare a cost sheet, a quotation, and the price. So please, you just have to be patient with us and follow the video throughout the session. And there are many other videos which we are going to put forward on this subject matter. So now here we equally have direct expenses. Let's assume that direct expenses are going to be, say, 60 of a certain material, 600 of a certain material X, say, at $100 each. So normally these direct expenses are supposed to come before the direct labor. So we create some space here, and then we take these direct expenses there, and then let's delete this one here. So let's assume transportation and all other things. Okay, let's say, yeah, and all other things. Let's just say gonna cost us, let's say $10,000. Okay. Okay, here we already have automatic formulas here. You simply take the quantity and multiply by the unit price, and then here transportation is this, and then we have what we call our direct cost. Our direct cost is that cost which can be traced to that particular job. Remember, we are trying to quote for a particular 2-bedroom apartment which we need to construct, which they are requesting for quotations, which we want to bid for. So here I'm saying that this direct cost is a cost that we can directly trace, that this cost will only be incurred by us on that particular job. So the total of this direct material, direct level, direct expenses is going to give us what we call the direct cost. Now, in addition to the direct cost, to material and the rest, we understand that they are certain normally when we be carrying out this construction, not all the materials will be used. We have what we call wastage. There are certain raw materials that normally in the process we're not going to use them. So we have what we call normal wastage, and in this process we are going to assume that our normal process, as per our past experience, because this normal wastage will only be established by the engineers and by the experts within the company based on their previous experience. Let's assume that it's going to be 20% of the direct cost. Also, normal wastage of the raw materials is 20% or whatever percent, depending on the company's policy and depending on their past experience. So when we do this now, we have what? We have our prime cost. Should be 0.2. We have now our prime cost. Now, our prime cost is what? The sum of all the direct costs, including the normal wastage. Now we get our prime cost, and now when we get our prime cost, we need to ascertain what we call what? Our contribution. Like I've explained here, in this situation, we are assuming that we are going to be charging a 20% markup on cost. So now 20% markup on cost entails, while we have our prime cost here, which is this, we equally realize that we have what we call overheads. Overheads have been computed as what? As 30% of prime cost. So overheads are those elements of cost which cannot be directly traced to a particular cost unit or cost center. So we are saying that these other elements of cost cannot be easily traced to that particular, the construction of that particular building that we want to undertake. But because of the fact that we are a company which has been operating and we have a structure, in place where we have an office, we have finance professionals, we have engineers, we have accountants who are working as permanent employees within the company, and we are incurring a certain amount of expenses in maintaining them within the company. It means that some of those elements of cost, irrespective of whether we have a job or not, the company is still going to incur this cost. So in order to make sure that as a company at the end of the day we are able to cover our full production cost or the full cost of constructing that building, and at the same time report a certain amount of profit on that project, we need to equally allocate a certain proportion of that our overhead cost to that particular contract that we want to quote. So here we assume that our overhead cost will simply be 30% of the prime cost. So now if we take overhead plus the prime overhead, our prime cost is here, overhead plus what? Plus our prime cost plus overhead, we have what we call our total cost. This is our total cost. Now if you look at our pricing here was that what we were assuming that we'll be making a profit markup of 30%. So if you take 1.3% and multiply 1.3% of the total cost, you're gonna get the selling price. Now we have what we call what contribution. Contribution is the amount of profit, or the amount of extra revenue which a company is going to earn after deducting its direct cost. In this case, if we take our sales revenue here minus our prime cost, we are going to have what we call our contribution here. Now we already have a contribution here which is about $355,000, and I've said, well, you take your selling price, the selling price, or the sales revenue, you less what? You less our prime cost, and when you take sales revenue less the prime cost, you're going to arrive at what we call our contribution. Now, after getting this, now if you take your contribution there, let's assume that we want to ascertain our net profit from this particular project. Our net profit here is going to be what? The amount of the contribution minus the amount of the overhead cost, or the amount of fixed overheads. Now at the end of the day, you realize that our net profit here is going to be what? $200,772. So now we are saying that at the end of the day, you now have understood that we have been able to ascertain the full cost of us undertaking that particular project. So in this case now, we can then come over here and then we say what? Quote for construction. For the construction of 2 BHK apartment. Here we quote our price now. The price here is this. Like I said, this amount is in dollars, so we have to change everything, convert everything in USD. Convert everything in USD. Convert everything here is in USD. So normally here, at the level of the direct materials, direct labor, and direct expenses, these are elements of cost that the finance professionals, or that the accountants, or the cost estimators are not familiar with all these things. So the engineers are the ones that are, or the construction engineers or estimators, or those actual engineers are the ones that are going to provide this relevant information to the estimation department. The estimation department will be relying on the quantity of the raw materials that will be used, relying on the quantity of the wastage that will be incurred in the process, and all this data will be taken from the engineer, from those who are practically going to do the job, who are actually versed and have experience in this construction job. The estimation department or the finance department does not have that expertise to be able to ascertain what will be used in this particular job. So like I said, the engineer or the construction engineers are going to provide this relevant data to the estimation department to follow the costing parameters that have been prepared by the finance team in order to be able to prepare their quotation. Now let's assume that maybe because of one reason or the other, after preparing this quotation, they send the quotation to the client, and because of one reason or the other, the client may say, oh, this price which you have actually quoted is not actually okay with us. We are not comfortable with paying, say, $870,000 for this job, but we think that your company is a good company that can render a good service to us. So what are we offering? We are not going to offer, we're not going to accept this amount of money that you want to give us, but rather we are going to offer you, let's say, let us say they have agreed to offer, let's say, 780,000. So now when we get that feedback from the market to say, oh, the marketer, oh, our people say we have prepared this quotation, the client is not satisfied, but the client is willing to pay, say, $780,000 instead of 870, which we actually quoted in our first quotation. So what do we need to do? They will need to communicate that information back to the exhibition department to say, oh, please revise your quotation. The client is not willing to pay 870,000. We want you to revise your quotation from, say, 870,000 to, say, 780,000. Let us see whether it's going to be profitable or not. So we have revised this, and as a result of revising this, you realize that what we are still going to be making a profit of what, 110,000. So it's a profitable project. So at this juncture, the initial price that we actually quoted was 800 and something, but client has said no, I can pay this, and then taking into consideration all the estimates that we took from our engineers and all the other costing fixed elements of cost which are within the company, we have realized that the project is going to be profitable. So we can then prepare a quotation and say, okay, yeah, we have revised our quotation downward from this to this. We are comfortable with this. This is how it should be done practically. However, let us see that the client said, no, I'm not going to pay 800,000. I'm going to pay you, say, I'm only willing to pay $600,000. Now, you realize that if we're going to pay $600,000, we are going to be making a loss of what? 69,000 something. But we are going to be having a positive contribution of what? 82,200. And this 85,200 is going to help us to cover part of our head cost. And you know, our head cost here is 154, which is fixed. Like I've said, this is a fixed cost. We're assuming that it's a fixed production, it's a fixed overhead here of this amount. So even though this project is not going to be profitable, but it's going to be giving us a positive contribution of what? 85,200, depending on the situation of the company. Assuming that the company does not have a lot of jobs, the company maybe has been idle, or the production facilities have been idle for a long time, or the employees are there, they don't have something to do, and things like that, the company may decide to accept this project. Why? Because even though it is not profitable, but it is what, giving a positive contribution to the company. So in our next session, we will look at how we can use this information in decision making. We'll use this information to see how we can analyze projects by how we can analyze each project at the end of the day, comparing the estimated data with the actual results at each stage of the project, to be able to track and know whether we are doing well or not. Thank you, and hoping to see you in the next session.